Good evening, everybody. My name is Clive Thompson. This video is brought out to you on the July the 29th, late in the evening. The markets have just closed in the USA, and the reason I'm doing this video is because I'm seeing something that I haven't seen in many, many years, and this video is not to scare you, but just to bring to your attention that something unusual is happening. I think that markets are currently perched on a knife's edge. And I don't just mean the US market, I mean all markets around the world, stock markets. That doesn't mean they're about to fall off to the other side. They could go rocketing higher, but one thing's pretty clear to me: they're going to move a lot from here, and they're not going to stay where they are for very long. And in other words, we're in for a major move in either direction. I think the dangers are to the downside, but we can't exclude to the upside, and I'll tell you why in a minute. So stocks are hitting record highs from New York to London to Tokyo. But the unusual thing with that is that the volatility, as expressed by the VIX indicator, is at a global low. It's very suppressed. And that makes everything feel very fragile, because when the volatility index is low, it means that people are very complacent. They don't expect prices to rise a lot. They don't expect them to fall a lot. But when it's like that, they usually move, and usually move a lot. So with global indices at all-time highs, is this indicating that we could go a lot higher or a lot lower? Well, I can't answer that question, but I can say it's fragile, very fragile. I mean, the London FTSE, for example, has just closed above 9,000 points for the first time ever. It's got a 41-year history behind it. Other major indices like the DAX, the Nikkei, they're at multi-year highs. But here's the thing which I think is probably the most concerning for most investors. And it's the index in which everybody in the world is heavily invested in, the S&P 500. And people are heavily invested in it because they own exchange-traded funds known as ETFs, which own that index. And an ETF has to own every share in the index in proportion to its market cap. Now, the market, if you take the top 10 stocks in the S&P 500, they represent 37 point something percent, nearly 40% of the value of the S&P. And the S&P is something like half the value of the world, if not more. Now, what we're saying here is that almost half the value of the world is in these 10 stocks. And if something happens to one or two of them, that's what the S&P is going to do anyway. It's going to be driven by those stocks, and it could drive the world in either direction. So if we have one or two of these Mag 7 or mega cap stocks stumbling, the broad indices around the world could tumble very, very quickly along with the S&P 500, which would be driving things lower. Now there's another concern that I'd like to draw your attention to, and it's something called credit spreads. Credit spreads is basically the spread between a risk-free bond, typically regarded as a Treasury or a gilt or a Bund, German government bond, or JGB, Japanese government bond, and a corporate bond which has a lower credit rating. Sometimes we call these types of bonds high yield or even junk bonds. But the spread, the difference in yield, has narrowed. That means the credit spread is very tight, is how we express it. Now, that's another sign of complacency. It means that investors are underpricing risk. So when you buy a junk bond or a high yield bond, you expect a higher yield to compensate you for the increased probability of defaults. So you buy a basket of those, you buy 20 or 30 or 50 or 100 of these high yield bonds, expecting a certain number to default, and you'll get a certain recovery rate on them. But you need, as a collection on those bonds, to be getting a higher yield to compensate you for the ones which will default. Well, those bonds are being priced at a very, very low level compared with what they should be priced at if you used their comparative, the risk-free bonds. So that's a sign of complacency, a sign that investors are underpricing the risks. And what's more, there's a possibility, it's not a certainty, that we'll go into recession. If we go into a recession, and it's looking more likely in Europe than it is in the United States at the moment, but it's possible in both. If we go into a recession, the level of bankruptcies increase, which means we could see a large sell-off in these high-yield bonds or junk debt, as I maybe prefer to call them. Junk is perhaps a misnomer because they're not all junk. Many of them will survive, but that was a term given to bonds after Michael Milken used to package them up and sell them en masse, and unfortunately a lot of people bought them. I think he went to jail in the end for doing that, but nothing's changed. People are still buying packages of these junk bonds and they're doing it because they get a high yield, and they're expecting that high yield to last in perpetuity, but sooner or later they're going to find the capital value of their bond fund will go down because there's been some defaults. And those defaults tend to come when there's a recession. Another comment we can say, in the United States, we've got relatively low unemployment at the moment, at least according to the official numbers. And don't forget, there's an awful lot of people who are dropping out of the unemployment index because they're not employed, but they haven't made an effort to look for a job in the last few months. Now, another thing which could worry the market, we've got tomorrow the FOMC meeting. The meeting's going on as we speak today, and it's going to roll in tomorrow, and then Chairman Powell will come out and tell us whether interest rates are going to stay the same or be reduced or raised. Now, I think there's zero chance of them being raised, and the market is 97.5% pricing in that there will be no change in interest rates tomorrow. There's still a 2.5% chance, according to the market, that they might lower rates, but that obviously is a very low probability. But it's not going to be the rate decision, which is likely to come in as expected, which will move the market, but it'll be the words that Jerome Powell uses after the announcement of the rates remaining steady. He'll give a little speech, and he's probably going to use very similar words to all the other speeches. Those of us who like a little bit of fun play something we call it banker bingo or FOMC bingo, where you've got a lot of buzzwords like 2% inflation or on hold or data driven. These are buzzwords, and as you see the buzzwords, you cross them off your bingo card and you see who can get the first line or the first completed card. It's a little bit of fun to stop you falling asleep in what otherwise is a very repetitive conference. But sometimes it's possible that some surprise words might come out and shock the market. But all ears and all attention will be on what signals he gives for the next meeting after tomorrow's or today's, if you like, which will be the September meeting. Will he be signaling a possible cut in September, and what words will he use around that? If it's being signaled because he's worried about the economy, well, that could send the markets into a tailspin. On the other hand, if he's just doing a cut because President Trump wants it, and he won't say those words, by the way, but if that's how the market interprets it, well, that's hats off. It's a massive bull market because everyone's been waiting for an interest rate cut for a long time. And that's usually bullish for the stock market, unless it's signaling some kind of possible recession or slowdown in the economy. But another thing which is going on here is the increasing pressure which President Trump and Scott Bessent and the administration is putting on Jerome Powell There's been all this talk about whether Jerome Powell will be fired, and they're talking about investigating him over the building costs. And there is a possibility that Jerome Powell might decide to fall on his sword, so to speak, and tender his resignation anyway. What if he announces it during the conference tomorrow? How will the market react? On the one hand, they might cheer and say, thank God he's gone, because now Mr. Trump's going to appoint a new president who's going to be a soft money man, a man who's going to print like there's no tomorrow. That's fantastic for assets. Stocks can go up forever. Gold price can go to the moon. Bitcoin will go shooting up, and we'll all be super rich. And of course, if we borrowed money, we'll be able to borrow that money much cheaper, and everybody's going to be a happy bunny. That might be the reaction. On the other hand, maybe the markets will take fright and say the Fed's independence has been undermined by the president and the administration, and we no longer trust the Federal Reserve to defend our interests as investors in government bonds, and expecting some reasonable efforts to tame in inflation. And then, of course, another thing which Trump will probably have to talk about is the tariff effect on inflation. For sure, tariffs are going to cause some increase in prices in the United States. And I've seen some estimates that it's going to cost the average American family an extra $2,400. I guess it's a year. Maybe it's a month, I don't know. But it's going to cost the average American family more to survive because of the tariffs than it did before. Now, if we got that inflationary effect coming in, it means that 2% target goes out the window. So what would happen if Jerome Powell says we're going to move our target for inflation not to 2%, we're going to move it to 3% or 2.5%? How's the market going to take that? We don't know. Could be good, could be bad. But with the fragile state of the markets, I think it's going to move markets if something like that happens. And there's a lot of things lining up to that. But I'm just going to finish off with telling you how I see markets today. They're being driven upwards, or have been driven upwards, by a wall of money. And that wall of money continues to drive these AI stocks higher and higher, and that's been the real theme and the trend over the last year or so. If it's got anything to do with AI, it should be going higher. And if I go back in time, back in the 1900s, it was anything to do with the railways, because the railways were all converging on big cities, and then the goods would change trains to another railway. And so anyone who owned a railway saw their stock price rise higher and higher as each railway company was trying to acquire the other ones to have that network that they needed. And then, of course, we had the Nifty 50, won't talk about that, and then the dot-com bubble, when anything related to, well, I remember days when, even getting an email address could boost your share price, and then it became getting a website, and then, of course, it became the dot-com bubble, where if you could stick .sys or .net or .com at the end of your name, you could get a boost to your share price. What other themes well, of course, look at what happened in 2021 with Reddit. There was a time when the AMCs of this world, the GameStops of this world, and silver price as well, were being driven by armies of people on Reddit who weren't investment professionals. They defeated the investment professionals by doing something that the market never expected. So we've still got that army out there. I don't know to what extent Reddit is important now, but one of the things I have noticed is important. I probably shouldn't say this word. I'm going to embarrass myself by saying the word tits. And I'm not referring to the people who invest in the stock market. I'm referring to boobs. That's perhaps a better word, boobs. I mean, we've seen, for example, this lovely lady, what's her name, Sydney Sweeney. She comes out and endorses a product, and simply by endorsing a product, it boosts the share price by 10 to 15%. So are we in a world where any kind of meme can boost the stock, and and now maybe we're just going to a world where everybody wants to hire pretty girls with big boobs because that will get their stock price up. Well, I'm telling you, I think it's a bit of a booby trap, not boobs. So watch out for it. But we are sort of in a hype-filled world where anything can drive stocks higher, but these things can fall apart very quickly. The Magnificent Seven, or the top 10 companies, which in the United States, that's the 10 companies which are almost half of the S&P 500 and therefore almost a quarter of the world. They are on relatively high multiples, well deserved, because for the most part, these companies are truly excellent companies with absolutely wonderful prospects. That's prospects for the businesses, but the share prices are already reflecting a lot of those prospects in the future. So if there's any adjustment to the way we think about their prospects, for example, if some more competition comes into the marketplace, reducing their ability to charge extra high fees for their AI services, or if there's some issue with one of the companies, such as a senior executive resigning or something like that, which we don't expect, that could drive the market a lot higher. And I will tell you that within the top 10 stocks, there is one. I'm not going to name it because I don't want to be responsible for moving prices. You can look it up and find it out yourself. But there is one stock which is not as financially sound by a long way as the rest. And it's very overpriced in my opinion. And I think that it's also extremely vulnerable to, one, the tariffs which are coming in, and two, any change of sentiment. So if that particular stock starts to tumble, it could very easily drag down the rest of the market with it, which is why I'm a little bit nervous about the market. But on the other hand, we've got this huge weight of money willing to jump on anything based on some new technology or some pretty influencer that people like looking at and say, well, if she supports it, I support him. So what if there's some sort of crack about the Fed credibility? These large mega caps dominate the market. Social media is moving stocks wildly in both directions. The Federal Reserve's independence might be threatened, which could cause policy shocks. So I think everything is set for bursts of volatility. We don't know what the headlines are going to be because I can't see in the future any more than you can. But what I can say is news is not usually good news. And let's wait and see. So thank you very much, ladies and gentlemen. If you want more updates like this from time to time, and they will be very, very rare, only when I see something about to happen. But I do lots of posts about how to invest in stocks, how to buy and sell gold, how to test if your gold and silver coins are real, for example. And I do lots of stories with lessons from history. Just click the subscribe button and a like. And I'd like to also say one last thing. On my last videos, I got hundreds and hundreds of absolutely fantastic comments, supporting comments, and it's the very nice comments like that which encourage me to keep going. If you've got any questions, I'll try and answer them for the next few days in the comments section. I might answer a few even later than that. And anyone who's got questions can also write to me on LinkedIn, and I'll do my very best to help you if you've got questions about investing or finances or stocks in general. So thumbs up, everybody. Thanks very much. Subscribe if you like this, and I'm looking forward to speaking with you all soon. Bye-bye for now.